Welcome to Private Capital Call, the podcast with leaders in asset management, investing, and capital markets. I'm your host, Randy Schwimmer. Our guest today is Chief Investment Officer and founding partner of Cresset Capital, Jack Ablin. Cresset Capital is a fractional family office, probably the best fractional family office that we know for high net worth individuals and families. And Jack, welcome to the program.
Thanks, Randy. It's great being here.
It's great to have you. And what we'd love to do first is maybe give our audience a sense of your background, what you do at Cresset, and then we can talk a little bit about some of the themes that you're seeing out there and dig into some of the specifics and details in terms of markets and all the things that we love to talk about on this program.
Will do. Randy, I've been in the investment business since the early 1980s, and my strategies has really evolved. I was a mortgage-backed securities trader working at not just the ground level, but really at the ticks and plus level of the bond market and trading in a period when the 10-year treasury was in the mid-teens and headed lower. You know, looking back on that period between when I started in 83 and when I really ended up moving out of trading in the late 80s, at roughly 1990, when I started doing asset allocation, I took a step back and realized, had I just looked at what the Fed was doing, had I just looked at the bigger picture and watching what I'll call the tectonic plates, I could have made my life a lot easier. I could have literally put in one trade at the beginning of my tenure and stayed home and made far more money than going in every day and trading for ticks and pluses. And so I think from that really changed my perspective on the markets. We had Volcker, and he was trying to break the back of inflation. Ultimately, he did. Mm-hmm. And so from roughly 1990, I started doing asset allocation. I worked on an asset allocation fund, mutual fund. And even here, our original mandate was, I was the bond guy. I was supposed to beat the Lehman Ag. And my colleague was an equity guy, and his job was to beat the S&P 500. Mm-hmm. Both tasks were pretty tough to do. We put our heads together and said, what, if we decide, rather than to try to beat each market individually, if we just shift between stocks and bonds, whichever we think has a better opportunity, we can make fewer decisions, have a fair amount of confidence in the decisions that we make, and make, far more return doing that than trying to, again, beat on each individual index. And so that was really what started my macro career, and it evolved. And so what I do now, 40 years later, is allocate capital. I look at all of the public markets and many of the private markets and try to put everything on a level playing field and recognize there's some illiquidity risk we want to account for, and duration risk and other things, credit risk. But I just want to allocate capital where we think the best rewards are and avoid areas where the risks are. So that's really the outcome of what I'm trying to do. And of course, over the years, developed a pretty rigorous process in getting to those decisions.
And Jack, besides being Chief Investment Officer at Cresset, you're also an author. And I noted that you've written a book called Reading Minds and Markets, Minimizing Risk and Maximizing Returns in a Volatile Global Marketplace. And I read some of the reviews on Amazon, which it looked like they were all 5 stars. So you've got some loyal readers who love what you wrote. Now, that you wrote that in 2009. So amazingly, that was 15 years ago. It feels like yesterday sometimes when I think about what happened then. But obviously, things have changed significantly since you wrote that book. But if you think about today, and, in your career now, where we are, particularly in terms of, you mentioned bonds and so forth, the 60-40 model, which in 2022 anyway, didn't look so hot and probably fed some of the appetite and interest in illiquid assets, came back in 2023 and seems to, have been restored in terms of some of the faith, certainly given what the markets are doing today. But maybe could you talk about what's changed from a macro perspective and maybe what's not changed?
Sure. I think the biggest thing that's changed from a macro perspective between 2009 and today is that at long last, bonds are now able to compete against equities with both arms. For that whole period from 2009 through the beginning of 2022, bonds had to try to compete for capital with one arm tied behind its back because of what's termed financial repression. The Fed artificially keeping interest rates below the rate of inflation in order to spur risk taking. And for the most part, it worked. But the bond market certainly did not command the respect that it ultimately deserves. And so, starting in 2022, after having suffered its worst one-year record in its history, it is now at long last on a level playing field with equities once again.
Mm-hmm. Now, thinking about 2024 and where we are from a macro perspective. So, rates seemingly have topped out. It looks like the worst is over. Inflation's still pretty sticky. So the Fed has signaled we're going to, we like what we're seeing. We're going to continue to watch. Haven't really signaled any immediate cuts in the federal funds rate. Very different than we were a year ago, right? When some people thought by the end of 2023 there would be multiple cuts. And of course, that didn't happen. Where do you see both kind of the direction of rates and the economy for this year? And how does that factor into your capital allocation decisions?
Sure. So there's, the simple process that I like to use in evaluating any market is one, valuation. Is a market expensive or cheap? Or is it relatively expensive or relatively cheap if I'm comparing it to something else? Two, the economic backdrop. Just like water in a fish tank, will it spur activity or will it just kind of freeze it out? Three, liquidity. The availability of money to borrow, spend, and invest. Is liquidity widely available or is it tight, making risk taking a little more difficult? Fourth is psychology. Now, I'll call that more of a spice than an ingredient, but I want to know what investors are expecting. And it was a very important figure in early this year because we had widespread bullishness, and and bulls have high expectations. And in a market where that reflects the intersection of reality and expectations, I'd much rather have investors have low expectations than high expectations.
Mm-hmm.
And then lastly, momentum. A market in motion tends to stay in motion unless otherwise acted upon. I think I just kind of
Little Newton, yeah.
Newton's law and apply it to markets. But really, the bottom line is we like cheap markets that are moving in the right direction, and we'll continue to hold expensive markets as long as they're moving in the right direction. But once an expensive market loses its momentum, that's a sell for us.
Yeah. It does feel like, I don't know what the market's doing today, but it feels like 40,000 is achievable, which a couple of years ago would have, if you'd asked me in March of 2020 during COVID, if we'd be at 40,000 at this point, I probably would have not taken that bet. But is that psychology going to last, that positive sort of buoyancy?
Well, it allowed investors in the first quarter to kind of on the equity side to part ways with the bond market. If you look at, as you pointed out, Randy, you look at the probability of a March rate cut back in the first week of January, I think it was close to 90%.
Yeah.
Of course, that plummeted to zero over the course of the subsequent couple of months. But the fact is that the optimism in the equity market stayed, while perhaps the bond market appears to be a little more realistic, where interest 10-year treasury yields went from, call it 388 to 430 in the course of the quarter. Now it appears that perhaps reality is beginning to set in for equity investors. We've had a couple of lousy days, the last couple of days, I think today down a fair amount as well. But perhaps we need to, come to reconcile that 6 rate cuts certainly off the table, 3 rate cuts, we hope, but that's not a lock either right now.
So given the up and down nature of market movements, what do you track? What kind of movers do you track when thinking about capital allocation, just given the fact that these things do move around? What do you keep an eye on?
Sure. So like I said, I am watching valuation. U.S. large cap valuation is stretched, at least when you look at it on a cap weighted basis. A lot of that overvaluation has to do with the promise of AI and some of the motion that we're seeing from that. If you strip it away and look at the average stock, however, it is more accurately priced, more realistically priced.
Mm-hmm.
So I'm not worried that we're in any kind of bubble. I will say, though, that tech relative to the rest of the market is trading at a 75% premium.
Yeah.
Now, during the tech bubble in the late 1990s, it got to a 200% premium. So we're nowhere near tech bubble area. And keep in mind that these companies are making money and they're growing their earnings. So there's certainly a lot more tangible benefits of owning these companies than there were in the promise of the internet back in the late 90s.
Mm-hmm.
So I think from that perspective, the S&P collectively, on a cap-weighted basis is overdone. But I think there are many pockets of the market that could potentially catch up once the Fed does start lowering interest rates later this year.
So that's helpful, and I'd love to now pivot to less liquid strategies in private credit, private capital, private equity, and that represents part of your business, I know. And I think our listeners would love to kind of hear your view as a markets guy tracking things like valuations. What is your view of private credit? It is right now probably the hottest sort of asset class. It also may be the least understood in some ways. From your perch, having visibility on both the public and privates, talk about how you look and assess private markets, given the fact that valuations are very different because they're not based on benchmarks or obvious public indicators. Liquidity is a very different model in the illiquid space, and frankly, even momentum now, which has taken over, just given how popular the asset class is for both issuers and investors. Maybe talk about your perspective, because you've got such a great history of understanding how these assets move. Talk about how you think about capital allocation for private markets.
Sure. So, let's look at private credit as an example. When you invest in the bond market in general, there are really three ways of capturing yield. There's interest rate risk, there's credit risk, and then there's illiquidity risk.
Mm-hmm.
So if you think about private credit, there's not much interest rate risk. It's typically floating rate. It resets every quarter.
Yep.
Yes, there's credit risk. Of course, there is some credit risk, but there's also illiquidity risk. And right now, the illiquidity premium available to investors to shift out of, call it a money market fund or investment grade bond fund or even a high yield bond fund and into private credit is enormous. It is probably, in fact, what we do is we look at illiquidity on almost like a duration basis, right? Because illiquidity in private credit is a lot less than the illiquidity in private equity.
Mm-hmm.
In general, private credit, these loans are typically, 3 to 5 years. Private equity, you're looking at 8 to 15 years.
Yeah.
And so, the weighted average return of capital on an illiquid basis is much lower for private credit than it is for private equity. And yet the premium available is relative to, let's say, the S&P 500 in private equity is much higher.
Sure.
Than the illiquidity premium available to private equity. And the same for and real estate too. In fact, really interesting dynamic between public real estate and private real estate right now. If you look at, for example, from the end of 2022 through the end of 2023, actually, I think it's the beginning of 2022, so it's 22 and 23, public REITs, particularly office REITs, are down 30-something%.
Mm-hmm.
Private markets, even in office, are down 15. And so there's the true answer is probably somewhere in the middle.
Okay.
And for that reason, I think private real estate is probably not as good a deal right now as public. So we would rather own real estate debt than real estate equity at this point, unless, maybe we can get equity kickers or whatever. But that's our view, that a lot of the marks in the real estate space have not really kept up with the public market reaction, which arguably could be overdone. And that's part of the reason why maybe public market real estate is a better deal. But we think private market marks have just not, still don't reflect reality.
Yeah. So one of the things that we started to hear when interest rates kind of plateaued was, oh, we love private credit. And yeah, you can get for example, senior lending, let's say 12% on an unlevered basis, right? That's really attractive. But look at investment grade bonds. I can get 5-6% or whatever, and high yield bonds I can get 8%. And for the first time in quite a while, because as you mentioned when we first started, when the Fed was keeping rates down to zero, bonds were not particularly attractive because you weren't earning anything. Now you can, but that trade is probably not going to last.
No, it's probably not going to last. But I will say there are several reasons I like private credit. But one of the reasons in particular is it's a great hedge against this higher for longer scenario.
Yeah.
So that when every time the Fed disappoints us and says, well, we're not ready to cut rates and that the probabilities of rate cuts now get extended out, we can shrug our shoulders and say, okay, here's another quarter. We're going to collect between 12 and 12.5% on our private credit portfolio. So in many respects, like I said, it's a great hedge. You mentioned that there's a fair amount of skepticism around private credit and that it's all of a sudden become wildly popular and there are a lot of assets moving in that direction. And you know what? On the surface, that's true. But I think we have to keep in mind that bank balance sheets over the last 18 months have shrunk by 1.3 trillion.
Right.
So this is would-be lending that would have gone into that same market that's no longer there. I've also heard anecdotally that many of the lenders that are on the private credit teams were at banks. They've just moved.
Right.
So many of my friends and associates who deal with their lenders are dealing with the same people. It's just the source of their capital has now moved from a bank balance sheet to a private credit portfolio.
Right, which it was designed that way. The regulators wanted it to happen, designed the system to happen that way, and created the opportunity for people like Churchill and Cresset to actually exist in this ecosystem in a way that is not only constructive for investors, but also for the issuers who have seen that bank appetite shrink to very little. And one would think that liquidity in any system would be welcomed, but I think it's the growth that scares them. I think your point about illiquidity is also super valid because it's a matter to some extent on the fact that these are private markets. Therefore, you can't look at a benchmark or a trading desk or a platform that you can actively trade, and therefore there's skepticism. There actually should be more skepticism on some of those public marks, just given my experience, on a bank trading desk, where what appears to be a mark that one could take advantage of actually isn't when you make the call to the desk and say, "Hey, I'd like to buy that." We'll talk about that element, the fact that credit is private in this asset class, and that the managers who manage these assets, obviously experienced in many cases, but unless you're actually an investor in the fund and you're just looking at it from 30,000 feet, you can't really tell what's going on. How do you explain that credit issue to people?
Yeah, I mean, I think that, we have parameters. We're looking at certain markets generally, just like, you at Churchill, we're looking at typically senior or senior secured borrowers or loans, I should say, oftentimes sponsor backed. So we're, dealing with a handful of issuers. It's just that there are many companies under their umbrella. And many of these sponsors will stand behind, their individual companies. And I think there's some benefit there that perhaps oftentimes goes unnoticed. The other thing is in the public markets, in the leverage loan public markets, covenant light actually means no covenants at all.
Right.
And the private markets still command certain covenants and tripwires and circuit breakers. And so as problems develop, then lenders can really act much earlier in the process than have to wait around for something bad to happen.
Yeah, it is one of those things that drives me crazy when I see comments about risk in private credit when, in fact, the public credit markets, high yield and the broad syndicate markets have way less protections in terms of covenants and so forth than private credit does. But that's part of the education, and that's why having you on this program is so terrific. Jack, as we wrap up our session, give us your kind of view. I mean, you've been doing this so long, and you think about maybe a little bit further into the future with the markets in general and private capital, private credit in specifically. How do you see the next few years unfolding? And for investors who need a little help in thinking about the options available to them, and your job is to kind of allocate amongst those options. What do you expect, and what should people be thinking about as they look at their own portfolios?
Sure. So in general, I will say on the private side in particular, on the public side, we love the mega companies. We love the big size and just the profitability and the global nature that they command. But on the private side, we actually avoid the mega deals. I have never really been able to reconcile mega cap buyout, for example. I think there are many studies that have shown that, on a leverage adjusted basis, you're better off just owning the S&P 500 than owning a mega cap buyout, private equity program. But there's huge opportunity in middle market. I think generally it's, because of perhaps the economies of scale, the big funds can't really play. There's just too many issuers. There's too much paperwork. It's too much work for the amount of assets that they have. And so I would say focus on middle market cash flowing businesses. We generally like those companies that are economically in sectors that are economically insensitive, and they generally fly under the radar screen, and we can typically find great opportunities on the equity side, but there are also great opportunities on the credit side as well. And right now, it would appear that I think the edge is on the private credit side, and perhaps once we get a sense that the Fed they will start to cut rates in earnest, maybe we'll take a closer look at the private equity side as well.
Jack Ablin, Chief Investment Officer and founding partner at Cresset Capital, and also author of Reading Minds and Markets, Minimizing Risk and Maximizing Returns in a Volatile Global Marketplace. Jack, it has been fantastic having you. Thank you so much.
Well, thanks for the invitation, Randy. I appreciate it.